Hello there, everyone, and welcome to the Final Bar. It's Thursday, August 15th, and I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we try to make sense of these markets. The foot of the general investing community continues to be on the accelerator as the growth leadership, the previous growth leadership, sort of renews its role in that leadership space with consumer stocks and technology names pushing the major indexes higher. The S&P, the NASDAQ, even small caps had a decent update. The VIX is almost down to the low teens again. All of that has happened in a very short period of time. What does that mean for the broader market conditions and our expectations for further downside versus the expectations of further upside? Let's get into our market recap and see how things played out. Again, we're continuing to see a complete reversal with the weakness, the weakest areas of the market that have been plunging sort of mid-July to early August, turning on a dime and bouncing higher much, much quicker. You can see the S&P 500 finished just above 55.43. That's up 1.6% from yesterday's close. The NASDAQ Composite up 2.3%. Mid-caps, small caps, all up as well. The S&P 600 small cap index matched the NASDAQ essentially, up 2.3% to the day. The VIX for the day, the VIX is now down just about 15, and that's down from 65 less than 2 weeks ago. So what does all this mean? So you're certainly seeing more of a risk-on feel to these markets. Mid to late July, it was very much risk-off with a spike in volatility, with an improvement in defensive sectors, all the classic signs of a major market top. What's happened here in the last couple of weeks is a complete reversal of all those conditions, right? So defensive sectors, which have been outperforming, starting to underperform here in August. Areas of the market that had been, struggling, like NVIDIA and the other Magnificent Seven stocks, bouncing very, very quickly, and in some cases making new swing highs. What's interesting about this market right here is that I would say, while we continue to push higher, while I would say charts like the S&P pushing back above their 50-day moving average certainly seem to be, for all intents and purposes, in the clear. This sort of environment, after the spike in volatility that we've seen, I think until you get to a new high and sort of eclipse the previous peak on improved momentum, it's still a bit of a question mark. What this also means is the volatility that we saw in the spike of the VIX, very real, right? I mean, if you look at what's happened in the S&P and the NASDAQ over the last 2 months, that is as volatile of a period as I've seen here for quite some time. So the volatility is real. The recovery certainly is real. The kicker is what happens next, right? And I think when you take a step back, put on your Charles Dow hat if you have one of those, do we make higher lows and higher highs? And if the answer to that question is yes, this is a market in an uptrend on whatever time frame you're looking at. If the answer is no, then we're not in an uptrend by Dow's original definition. So I think when periods like this are uncertain, make that assessment. We'll look at the chart of the S&P and some other charts here today and try to make that assessment with you here on the show. But undeniably, and what drove this? This is retail sales earlier in the morning. There was some earnings that came out, like Applied Materials after the close. You had Walmart's earnings, and certainly they Walmart gapped higher. But to be honest with you, this is more of a macro thing between the PPI on Tuesday, the CPI on Wednesday, retail sales today. Basically, all of those have suggested inflation not a huge issue, economy not shrinking in too painful of a way, recession fears, which seemed magnified, I feel like a week ago, all of a sudden sort of pushed aside, and investors getting way more optimistic very, very quickly. The reason why it's not so easy to proclaim this a new bull market phase is this is what bear market rallies feel like, right? I always say they're sudden, severe, and seductive. Those are the 3 S's to describe a bear market rally. Sudden in that they happen very, very quickly. Severe in that they are an aggressive move. It's not just a quick time, it's a quick price reaction where all of a sudden, if you were bearish, you feel like you are completely on the wrong side very, very quickly. And then the third one is seductive. It's very tempting to jump back in and reinitiate long trades. And if you're super tempted by this move here, I don't blame you. And I have to say, I get it. The reality is we have to make the assessment based on the weight of the evidence and then be prepared to adjust that assessment when the picture changes. We're getting to that point where the picture certainly feels like it's either very close to changing or in some cases we're seeing the upside follow through that we talked about being patient and waiting for. Having said that, 10-year yields up a little bit here, 3.93% for the 10-year, long bond yield around 4.2%, 5-year yield around 3.8%. So bonds actually selling off here. We had that situation where bond prices have been rallying for quite some time, and the general trend has not changed. I think the TLT generally trending higher, rates generally trending lower, but we're seeing rates kind of with a counter trend move back to the upside here this week. Dollar index up slightly. It looked like 0.4% from yesterday. Commodities mostly in the green. Gold and silver actually moving slightly higher. Gold, the GLD up about 0.3%. Silver up almost a full 3%. Copper prices as well. So I maintain that gold and silver are attractive charts. I love the fact that in an uncertain period for equities, which I would say this is undeniably uncertain, and anyone that has super high conviction on what you're seeing, I think you're in that way you're ignoring some clear evidence on the other side. I think this is one of those times you really have mixed evidence. I would say if you really look at the weight of the evidence with an absence of bias, or as much as you can pull off in your own process, I think you can see arguments on both sides of the ledger right about now. However, gold and silver certainly from a trend perspective pushing to the upside. Crypto land not looking as clearly positive, and I would argue the chart of Bitcoin is actually more clearly negative here. You're going to note when we look at the chart of Bitcoin in a little while here in the market update, breakdowns pulled up over the last 24 hours, failed to get back above 60,000, big round number, now rotating lower, currently around 57,000. This represents a lower peak and a failure to overtake moving average resistance, and I think that might be an important data point on crypto. All right, looking at the 11 S&P sectors, the reason why our benchmarks are up big is because some of the biggest sectors representing a lot of market cap are up big as well. Consumer discretionary, the XLY, up over 3% today, 3.2% exactly. Technology up 2.9%. Materials and industrials, third and fourth, up about 1.5%. On the downside, only one of the 11 S&P sectors, real estate, was down about 1/3%. Utilities essentially flat for the day. Healthcare, number 3 from the bottom, up about 2/3%. We don't update our market trend model, so I hesitate to draw too much on it just yet. But if this was Friday's close, our short-term model for the S&P 500 would have turned back bullish. So if we don't get some big sell-off on Friday, our market trend model will return back to bullish across the board. And it's been a little while since that has been the configuration. We'll look at that chart probably going into the beginning of next week. We'll do some additional work on that. Certainly updated after the close on Friday. And as I'm saying that, as a reminder, I'm on vacay all next week, taking the family to Ireland for the first time, which we're super excited about. So if any of you have any suggestions about things to do, we're flying into Dublin and spending about a 10-day stretch navigating around and exploring on our own. So if you have any suggestions, drop a comment below and let me know. I'd love to hear your ideas, those of you that are familiar with the area. We tend to pick a spot and go blind as much as we can to just sort of ask for questions along the way and see where the wind blows, see where things take us. It's a nice counterweight to our overscheduled life. I feel like we are with school-age kids and work and personal responsibilities. So interested if you have any ideas, drop a comment below and let me know. But we will be doing a special series all next week. We're going to unleash the top 10 charts to watch for August. 2 charts every day. So through the course of the week, you'll get the 5, and actually did a specific theme on each of those days. So make sure you watch through them. I'm very interested in what you think about the 5 different themes that we highlight and how things can evolve very quickly, of course, as we get back into or continue here in Q3. All right, sorry for the digressing a little bit there, but let's get to the Magnificent 7. Most of these doing quite well, particularly Tesla up over 6% today, Amazon up over 4%, NVIDIA up over 4% as well. So the XLY, Amazon's the biggest weight. Tesla's up there as well. So Amazon and Tesla up to the degree that they are is going to take all of the XLY, or certainly that cap-weighted ETF, to the upside. All right, let's look at a daily chart of the S&P, check in on where things are at after today's trading. So we've talked about some lines in the sand, right? And what we talked about on this chart here in recent weeks is comparing what we've seen now versus these previous observations. And 3 things that I said you would look for. Number 1, a break above trendline resistance. That happened in November. That happened in May. That happened today. Break back above the 50-day moving average. That happened in November. That happened in May. That happened today. Third one was a break to a new swing high. You can see we got that here about a week after in mid-November, breaking above the October peak. You saw that, really here in May, breaking above that peak, although we did have a pullback to resistance, which is a pretty common technical phenomenon, kind of that breakout and pullback before moving to the upside. We've not quite done it, right? I think to complete this sort of breakout trifecta that I've talked about here recently, you have to get above 55.50, which is pretty much today's high. So tomorrow into next week, you need to break above that resistance and have some follow through. At which point, a return to the previous all-time high is a bit of a foregone conclusion from a technical perspective. Now, it's not guaranteed, of course, right? And I would say if we do break higher, I would then be looking to see if we have some sort of double top. The question is going to be, are we able to make a new all-time high? And if and when we do, what's the momentum look like? Couple things that you could see that I think should raise a red flag. Number 1, we don't break above this July peak, because for now we've been making a pattern of lower highs and lower lows. And when that stops, that's when it should tell you, okay, maybe something's different. That's why this breakout in May and this breakout last November were so meaningful, because we had broken to a new swing high. I would be looking there to see if we can get above the late July high. If we do that, and if we can get up to 56.50 and threaten a new all-time high yet again, it's all going to be about the momentum. What you could do is have this mid-July peak with an RSI around just above 80. You could have a secondary peak here with the RSI not up to 70 yet, and that would be kind of a warning signal called a bearish momentum divergence, right, where the price is making at or near a new high, but the momentum is nowhere near doing that. But for what it's worth, the lines in the sand we've talked about, breaking above trend lines, breaking above the 50-day moving average, both of those things have now happened. My question now for the market going into tomorrow's session and into the beginning of the next week, do we get above 55.50? Do we get follow through, right? Trade not just to resistance, but through resistance. But for now, undeniable, this risk-on move has been pretty impressive. It's certainly gone farther than I would have expected given the spike in the VIX. One of the many things that are head scratchers here in 2024 as we, as always, try to adapt to new market conditions and market dynamics. We make a new swing high. I think you have to then think about a pattern of higher highs and higher lows. And then after this, right, it's like, do we make a higher low? Where does that next low kind of come in? And again, all of this is happening in the seasonally weakest part of the year. August and September are usually pretty rough. August in an election year, people will probably remind me, because I said it was not a big deal. August in an election year actually often tends to be pretty strong. So here it is, an election year in August is fitting the bill, following the election year tendencies. Always enjoy learning here as an analyst. All right, let's keep going here and talk about some of the other breadth metrics just to get you caught up on where things are at. So we talked about the McClellan oscillator pushing back above key resistance. I think I just want to look at small caps, to be honest with you. We talked about breadth a little bit yesterday, and what's clear is the breadth conditions have continued to improve, right? That really isn't something that has followed necessarily the trend in the S&P and the NASDAQ as much, but you're certainly seeing that upside follow through. Here's the chart of the IWM, which is the Russell 2000 ETF. Now, the Russell 2000 is making new highs with just this brilliant breakout pattern here. One of the things that I was thinking about, just thinking about what's happened here recently and how to try to make sense of it. Let me show you this. If we take a trend line, boy, I'm trying to do this while I'm talking here. I think I can do it. All right, so we make a trend line. We make it like this. I'm just going to show the that vertical distance. We copy that. I mean, look at how well that matches, right? So what this is doing is basically saying, all right, this was the coil pattern that we talked about, sort of this symmetrical triangle pattern, right? You had the rally in the first quarter of this year. Then we had a pattern of lower highs and higher lows for small caps. When we gapped higher and broke out of that range, that to me is a raging bullish breakout signal. But the traditional measurement to give an upside objective is to take the height of that pattern and then project it from the breakout level. And if you look at it, almost perfectly indicates that is a likely topping point. So there it is. The measurements of price patterns apparently still working here, which that's encouraging. What's happened since then is we've obviously sold off quite a bit here at the beginning of August, but it was short-lived. We really only had 3 big down days for small caps. And then all of a sudden, we've been popping higher with the rest of the market, just not as much as the major averages, which have outperformed a little bit here in August. But you're seeing the RSI that bottomed out at 40 as we tested that 200-day moving average. We're now back above the 50-day moving average, just like the S&P 500. And I would argue this is now sort of suggesting a bit of a return back to retest that those previous highs. The momentum overall is quite encouraging as we've had that bounce off of the 200-day moving average. So small caps in some ways are a measure of market breadth because you're sort of ignoring the biggest names, kind of looking at everything else. And it doesn't have the overweight, top-heavy condition that the S&P and the NASDAQ do. For what it's worth, interesting move higher. I do want to point out the NAAIM Exposure Index, talking briefly about sentiment. The VIX, of course, continuing to pull back down below 20. Today, almost down below 15, which seemed absolutely incredibly unlikely not too long ago, but here we are. Did want to highlight the NAAIM Exposure Index, which is a measure of sentiment. This is a survey of money managers. It's basically people that manage other people's money, active money managers, and you can see that this week's number comes in even much lower. Last week we were around 75%. This week even lower, around 57%. And what this implies, and there could be a lag, of course, between when people respond to the survey because it's gathered over the course of a week, I believe. I'm not entirely certain of what that window is, but I know it's posted sort of Wednesday evening, so we were able to post it on Thursday. And today, you see the percentage allocation to equities is down, essentially underweight. So what this implies is that money managers, at least in this survey, are fading this of this period here, July into mid-August. Now, as the market would continue higher, if we blow up to new all-time highs, I would think highly unlikely this allocation doesn't rip back to the upside very, very quickly. And if we continue to go stronger, I wouldn't be surprised if next week's, you see it a lot further up. I wouldn't be surprised by that. But I would tell you that this is one of those things that has remained quite bearish, has been the fact that money managers in the survey have been lightening up since the end of June. Now, that made a ton of sense here as we were selling off in late June. All of a sudden, the last 2 weeks, it's a bit of a head scratcher that we continue to go down. It could be a lag as part of that. That's certainly a possibility. The other hand is that the quote unquote smart money is still fading, and maybe this bounce is very much a retail driven, over optimistic bear market rally FOMO kind of move before we start the next leg lower. And I've seen a number of your comments. I appreciate all of you that take the time to comment below our daily show. Saw some of your comments about not trusting this rally, and I'm with you. I think there's a lot to be concerned about. I think there's still a lot of the macro conditions we talked about have not been magically, with a magic wand, gone away with. They're still there. And I think this quote-unquote soft landing still has to be navigated. I think there's still some open questions, but the broad macro data we've gotten this week certainly, getting investors drawn back in. It's just not reflected yet in the NAAIM Exposure Index, which is something to think about. Let's look quickly at Bitcoin here. Boy, we're running a little long. Sorry about that. Bitcoin, if you look here, you can see, right, so we're kind of rotating lower here this week. Now, what's happened is Bitcoin hit 70,000, big round number, traded below 60,000, got all the way to just below 50,000, another big round number. We then traded higher, got back to moving average resistance, the 50 and the 200-day, just because of the weird way that this has been trading, all kind of coalescing around that $61,000 to $63,000 range. And as you can see, we actually traded up to there just over a week ago, and now we're rotating back down. So now we've made a lower low. We're now confirming a bit of a lower high. The RSI didn't get back above 50 here so far in August. That is a chart in distribution phase, I would say undeniably. Lower highs, lower lows, weaker momentum. I think this is a chart that looks compelling, looks interesting. Once we stop going down, once you see signs of accumulation, and I'm not seeing that on this rally, I'm seeing momentum still relatively weak. I'm seeing the inability to get above resistance. So compare that to like the S&P breaking above trend lines and moving averages. This one actually unable to do that. That's what differentiates the nice recovery charts from the not so good charts. Something to look at there. Looking at the market carpet today, again, the reason why the benchmarks are up, look at the biggest, brightest green in the upper left. Now, I'm here actually looking at the last 5 days. I'm looking at the last week. Here's the 1 day percent change. And again, you can see NVIDIA, a lot of technology in the bright green. Amazon and Tesla, your two biggest weights, pretty significant. Just look at the size of the boxes. You can see how Amazon, Tesla, Home Depot are essentially about 50% of the XLY. So when those two stocks are up, That's going to drive things up as well. You can see Walmart up big related to earnings, but outside of there, in sectors like financials and healthcare and staples and utilities, a bit more mixed and a lot more neutral than you see in technology and certainly in consumer discretionary. Now, when you look at the last 5 weeks, last 5 days, this really shows you the strength of this sort of recovery rally. Look at the returns that we've seen just in the last 5 trading days. NVIDIA up almost 20%, Broadcom 14%, Apple and Microsoft about 5%, Meta 5% higher. Alphabet, a bit of an outlier. So let's look there. I actually wrote an article for CNBC Pro, and a number of you have mentioned that you've followed my work there. I appreciate so much if you do. Wrote an article today about Alphabet, and read there for a lot more information. But we're sort of approaching that key moving average support level. Alphabet's an interesting chart right now because it's diverging quite a bit from the NVIDIA, Meta, Apple kind of charts, which are all seeing this strong recovery in August. Alphabet's actually down for the month of August so far, slightly. And you can see we're testing the 200-day moving average. Fibonacci retracements using a couple of these major lows connected to the July peak, all sort of lining up in that 150 to 155 range, pretty much where we've had a low for August so far. So this is one of those charts where if we're going to find a low, this is pretty much the level at which it would make a lot of sense based on the charts. And if 150 would not hold, that would actually get us to a new low for August below the 200-day, and would suggest to me much further downside potential. Right now, we're sort of stabilizing, but note how so many other things have had this nice vertical move in August. You really haven't seen that with Alphabet. It's stalling out here. So can the 200-day hold? It did in March. I'd be very keen to see if it does. And I don't have a problem with, taking a position, betting on that area holding and just keeping a stop sort of below the 200-day slightly would be a great way to sort of manage that downside risk and bet on a potential return to retest the previous highs. I get the argument there, but I think Alphabet is a key place to watch for sure. Now, ULTA, your biggest gainer in the S&P 500 today, up over 11%. What concerns me about the chart of ULTA today is that gap higher was sold. The chart of ULTA reminds me of a lot of the charts we've talked about, like ELF Beauty and others that are in these primary downtrends. And those charts, of course, look negative. And maybe not ELF as much as something like a Warner Brothers Discovery, and think of some of those media names. They're just in this nice, consistent downtrend. It's continuing to just pound further and further. Walgreens Boots Alliance, WBAA, is a good example of that. Sort of nice, consistent downtrend below downward sloping moving averages for months and months and months. ULTA's sort of one of those stocks, right? Broke to a new 52-week low just in the last week. Today, gapping higher on a nice earnings print. The problem is it gapped higher, did not eclipse the 50-day moving average. That gap higher was sold off because the stock actually traded lower through the course of the day after that higher open. So I would say, even though this is the biggest up mover in today's session, still some to prove before you can determine that it's a nice upside follow through. NVIDIA did break above today the level that we talked about yesterday. Yesterday we talked on the show about that 90 to 100 range. We're kind of looking at this shorter time frame, sort of looking at 100 as sort of the upper end of this gap, sort of that big round number support on a closing basis, pretty much where we found a bottom in early August. 120, the 50-day moving average, and the swing high from late July. For now, we did yesterday have what's called a hanging man candle. The market did not care, up another 4% today. So again, for now, NVIDIA breaking above trendline support, breaking resistance, breaking above the 50-day moving average, breaking above that bearish engulfing pattern from late July. Look to see some signs of short-term distribution, but for now, I'm not seeing it. Now, what's interesting now, as we've broken up, I think I immediately glanced down to the RSI to see if this can push above 60. And I'm just looking for any sign, even though the short-term trend is certainly higher, looking for any sign that that trend has changed. And so for me, the momentum not matching the trend is one of those warning signs. So if this keeps going higher, but the RSI doesn't get much above 60, that can often be the sign of a false rally. But for now, nice follow through. Can we finish the week above the 50-day? That would be my question there. Just to finish off, I'll show you a couple candle patterns that I think are kind of interesting to watch. This is FICO, which is in the financial sector. Bearish engulfing pattern. If you've always wondered what one of those looks like, you probably don't if you watch this show because we talk about them before. That's when you have a big up day and a big down day. Day two's body engulfs day one's body. Bar chart users would call this a bearish outside day, kind of the same thing. So this is a bearish engulfing pattern suggesting the next 1 to 3 bars are most likely lower rather than higher. General Mills in the consumer staples sector having a very similar pattern here, a bearish engulfing pattern. We saw one of these in early August. We did trade off a little bit, but ended up pushing to a new swing high just above $71 today, sort of confirming that bearish engulfing pattern, suggesting short-term weakness for the next 1 to 3 days. I'm seeing a number of these in sectors like financials, consumer staples, on some names. And again, while that doesn't negate sort of the larger trend characteristics, it does suggest some short-term weakness. So some of these defensive areas seeing a bit of a distribution here on today's session with growth working and these areas of the market struggling. Last one I'll show you is AT&T. I'm highlighting a bit of a bearish momentum divergence. Now, this is something we looked at. Today, it's down about 3%, which immediately reminds me of the bearish divergence that we've been observing from being overbought in late June, testing the overbought level in mid-July. And here, we're making a new closing high on weaker momentum. And that's been the trend here. So higher highs on weaker momentum, suggesting maybe there's a bit of a pause in that uptrend. So very much this week, to wrap up today's show, you're seeing stocks like AT&T that have been in nice big uptrends, defensive areas of the market, showing signs of distribution here, at least in the short term. Some of the growthy areas that were, I think, most questionable in late July, all of a sudden showing quite a bit of strength. How we navigate these periods for me is all about tracking some of these particular levels, being honest when those levels are broken and when the signals change, and reflecting that in your outlook and in your positioning as well. If you have questions, I hope you'll drop them below in the comments, and I look forward to answering them in our next mailbag episode. Folks, that's a wrap for today. Thanks so much for joining us every weekday after the close. For Stock Charts, I'm Dave Keller. Be well, stay safe, have a good one.